Hey guys, it's Hex here, and today I'm going to be talking about a very, very important theory that a lot of you are going to need to learn to be successful. Okay, and essentially what it is it's a theory created by Ilyan Yotov, right? He is or was a market analyst that decided to essentially try to look at the market and try to figure out how the market actually moves, as well as how the market how the market reacts to certain levels, right? And us as humans, we all tend to prefer numbers that are even. We tend to prefer numbers that are connected, whole. So because of that, we want to study this theorem, and essentially, it is called the quarters theory, right? It's called the quarters theory, and this quarter theory essentially speculates that in the market, there are certain levels, there are certain pivot points where the market will respect or will at least, show either strength through them or will respect them and reject off of them. They should usually be used as targets. They shouldn't really be used as end all be all. But at the same time, there's something that we can all take a little bit of a lesson from. So starting off, um, there's going to be a couple things that we need to go over first off. First off, we need to go over how to actually read a pip. So let me go back to the EU chart, right? If you press shift on TradingView, or if you press shift, if you hold shift and then you click and drag, you will actually see a little ruler. And this ruler essentially shows how many pips you've just moved. So you go to the last number and you read negative 121.7. So this range right here moved down because of the negative, right? 127 pips. Right now you can just click away. And what you can also do is essentially what you want to do is right here on the side, right? There's going to be certain numbers. The 1.1980 is what's important. The last number is called the micropip, and it's not exactly very important, but the next ones are. Let's go actually write this down. So it's 1.9800, right? And now what's important is essentially these numbers, these ones right here and this one right here. This one you can kind of just erase because you don't really need it, right? And because of that, these are essentially going to have the same rules as numbers. You guys should know these, right? The tens, the hundreds, the thousands places, right? And how you're going to count these is essentially this way, right? You're going to have something called a major quarter, right? And that major quarter, essentially, you can color it whatever color you want on TradingView, but essentially it holds every 1,000 pips, right? So every 1,000 pips. So every 1,000 pips, you'll have a big red line. And that essentially shows the end of the range, right? Because that's the end of a whole number, right? And these whole numbers will help you in your trading. They're called, some people call them psychological numbers. Other people call them institutional numbers. Whatever you may call them, they are very, very, very important. So, these are 1,000 pips. These are called the quarters, right? So they're called. Actually, let me not write with my mouse. Let me type it out here. You can call them major quarters, right? Cool. So this is a major quarters, and they are every 1,000 pips. Okay. The next line will be called the I call them secondary quarters, or just call them a secondary quarter. And they're going to be every 250 pips. Going to be one in the middle, right? And obviously one down here. So let's pretend, right? Let's pretend that this is 0 and this is 1,000. Each one of these in the middle, sorry, let's think of it as like 100, right? This one right here in the middle is going to be 250. Then the one above it is going to be 500. And then the one above it is going to be 750. Oh, whoops. Right? So essentially, each one of these goes up. It goes up another 250 pips. Okay, so it'll go the 250, it'll go the 500, and then it'll go the 750. Okay, why? Because it's 25, 50, 75, right? You just count by 25s and then add the 0, right? Basic math. The next one is going to be also very, very important, but these are a little bit less important. I call these the minor quarters, and essentially these break up this 1,000 pip range into digestible chunks. So each one of them, one right here, one right here, one right here, and one right here. And essentially each one of these goes by 125 pips. Okay, 125 pips. So if this one was, 125, and so on and so forth. Okay, and that's how they go up. Now, to use this, you essentially have to know how to count a pip, or you can just measure out, 250 pips, 125 pips, however you want to do it. So now that we understand how to place them, let's go see how to use them. Okay. Usually how I go is I go up to the weekly, and I try to find the nearest whole number. So in this case, let's measure out 1,000 pips. 1,000 pips is right around here. So between the 1.3 and the 1.2. So let's go ahead and press Alt H on our computers. We have the purple line, whatever line you really want to place. I place whatever line you want to place. I up the thickness for them though. And then from here you would just place 1.3. That's 1.3, right? So then the next one would be 1.2. Right, 1.2. Let's check how many pips this is just to make sure. Shift, click, and drag. It's 1,000 pips in a range, right? So now that we have found our range, we can go one above or one below, right? When you see price, you usually want to place one above and then one below, just in case, because you're still within that range, right? You still haven't broken out of those quarter points yet. So you want to keep them in mind. So the one below is obviously going to be 1.1. Perfect, right? You have 1.1. Now, again, let's go ahead and change the color for them just so we know which one is which. Right, and we can put it like that, boom. Coordinates, and then we can have 1.1 to 50. Always keep this front number in front, right? And then from there, what are we going to have? We're going to have 1.15. We're going to have 1.175. Perfect. Now we've actually drawn up a range, okay? And essentially what these are is range trading. These are especially good for, say for example, US 30. US 30 trades between these ranges amazingly. Usually you don't see US 30 stop within the range and just reverse, right? Usually you actually see it hit one of these quarter points and then bounce off of them. These are very, very good for a lot of ICT concepts or smart money concepts, because what end up happening is in these smart money techniques, you end up wanting to use certain structure off the daily, you end up wanting to use certain structure off of whatever, and usually these points are and these psychological points, these whole numbers, end up being the numbers that get us most results. And the next one is going to be 125. So again, we change the color and we can reduce the thickness as well. The coordinates are going to be 125. And if you need some help, you can do 125 plus 125. Okay, what can you guess it is? It's 250, right? Which was our next point, right? So it's 250 plus 125 is equal to 375. Perfect. And now this 375 is going to end up being our next number. Okay. And then this next number, what do you guys think is going to be? 625. Right, 625. And the last number is going to be 875. Perfect. Right, and now you've completed your range right here. This is essentially what you want to have on most of your charts, just so you know exactly the pivot points of the market and where you can expect an actual reaction from the market before you start, trading. To me, these have helped me a lot. This is going to be a bit of a shorter video. I'll show you guys how to trade them in just 1 second. But the reason why I'm showing these to you is because a lot of times, right, banks and markets like to go off psychological levels because they're easy, right? It's easy to calculate a number off of an even number, right? It's easy to memorize. It's not hard to know where to target if it's an even number, right? A lot of times you see these targets, shot above a couple pips and then reverse down, or hit them and then continue going down. And you will see a couple examples a little bit later on. So let's go ahead and add our other lines, right? Which end up being these. Let's drop our thickness and then let's go to 225. Perfect. So need one more, 250. Boom. And then our last one, 7, 5, boom, right there. Right, and then our last one are smaller ones. You guys should know how to do this, but I will show you one more time. You can kind of use this as a little bit of a guide, right? 1.2125. 1.2375. Usually the ends of the numbers are going to be the 375, right? The next one is the 625. And the last one is 875. Perfect, like that, right? Now, whenever you want to backtest a strategy, usually you want to use Euro USD because it's one of the most volatile pairs, and it's one of the ones that is very, very good to test strategies on. So, apart from that side note, let's go ahead and look at what it does. Essentially, you see how the market reacts to these? Market reacts here. It completely breaks below, and down here is most probably another position, which I think that would be the 50. Let's see. Yep, look at that. It reacts right off of the 50, right? So once it breaks on the weekly or on the daily, right, it breaks below this, what would have been the 2.5 or the 250, you would have targeted its immediate brother, which would have been the 500. Oh, whoops. Oh, never mind. Whoops. It would have broken the 7.5. My fault. Right, so it would have broken the 7.5 right here. Boom, breaks through the 7.5 and actually holds this level. Right here, it holds this level. Here, it holds this level. Like I said, these are very good confluences similar to premium and discount, where you should be using them as kind of a target or a confluence, because usually whenever you target these, they will get hit, right? So it doesn't exactly mean, hey, there's a quarter point here, I know it's going to reverse. No, you should be saying, oh, there's a quarter point there, that will be my target, right? They're very good aiming tools. So sometimes they do catch ranges. Sometimes they do help you gain a lot of confluence, saying like, okay, there's an order block here, and then there is also a quarter point. Perfect. You just got a lot more confirmation for your bounce off that for your bounce off that order block, right? Perfect. That's completely fine. But you don't want to use them as you don't want to use them as like the Bible, right? You want to use them as a certain target in major positions. So for example, right here, we already wicked a quarter point, right? We wicked a major quarter. Since we wicked this major quarter, what we end up wanting to do is saying, okay, are we going to hold this quarter, or are we going to target the next one? Right? Are we going to hit this quarter and go through, come up here and purchase these highs, or are we coming back down to touch the other quarter? Usually, right, getting rid of these little orange ones, which are the minor ones, you don't always need them. A lot of times they're just a little bit distracting. You don't exactly need them, but I'm teaching you how to properly do it, right? If you want to keep your chart like this, it's completely fine. But just so you know, like the major quarters and the whole points, right? These are the whole points, the 1.3, the 1.2, the 1.0, right? Those are major points. And because of that, you want to keep those essentially as the most important ones. And you can also keep their minor points, meaning the 2.5, 7.5, the 50, right? Whatever. So whenever a point is rejected, usually the target ends up being its brother or its other quarter point, right? You never see it get rejected then shoot back in. Usually, most of the time, if it's rejected off of a certain point, it will go to the next quarter point, right? So for example, right here, it rejects off, booms, right back into the quarter point before shooting back up. So let's go ahead and look at this position a little bit more closely. So you see how right here on this week, it actually shot back to the other quarter point, rejected the quarter point, and then came all the way back up, right? And then once it rejected it and came back, and it ranged back up, hit the top quarter point, and then went down. Now, when this quarter point was broken, it actually went back down to the major. The major was broken, retested, and then actually continued back down to target the next quarter point, right? You can use them as very, very influential levels that you can say like, okay, this is I see that it rejected off of this point. I see redistribution, or I see distribution. I know that my final target will be down here, right? Which is still a hefty amount of pips. But you would have said, okay, I know, like for example, let's say up here, since we're on the weekly, let's assume that you see redistribution, down here, or you see distribution up here, and you decide, how you usually trade. You identify your schematic, you see if there's any liquidity that needs to be taken out, right? Which obviously there was back here, but it gets taken out, let's say, and then from there you end up taking that sell. Right. When you take that sell, how you manage your take profits, especially on larger positions that aren't, from New York session, that are just, 100 pip, 200 pip TPs, you want to end up saying, okay, what would be my swing TP? These are extremely, extremely good for you to actually, for you to use as targets. So essentially what you want to do is you want to take these positions and you want to aim for them. Usually when these ranges get broken, they will usually get close or will touch its other quarter point. For example, right here it breaks below and it barely misses this other quarter point. But then it comes back up, rejects off of this quarter point, and then completely goes to the next one. This quarter point is rejected, and then it completely goes up to the next one. This quarter point is broken, and it goes up to the next one. So you kind of want to use it as added confluence, right? It's still very good. It's still very influential. It's still very smart money, but at the same time, you want to use them with a bit of sparing. You don't want to use them as that is how I trade. I trade from quarter point to quarter point, because that won't really work, right? You can't build a house with just a hammer. You can't trade with just Wyckoff. You can't trade with just liquidity. You can't trade with just smart money entries. You have to mix these together. So, for example, let's say right here we know that this quarter point was broken through, right? But it was rejected ultimately on the weekly candle. What do we know? Most likely we're going to get a tap of the top quarter point, taking out this liquidity, mitigating losses. Now what? Now that we know that, we also know that this is exposed liquidity. We're up here. What should be our target? Down here. Why would this be our target? Because we already broke this quarter point. We came back and retested this and missed it by like, what is it? We missed it by like 30 pips, right? We missed that quarter points by like 30 pips. So what happens? Now we know that our next target would most obviously be down here because of this exposed liquidity. Now that take profit would have been hit and it would have kept going. But do you see how it rejected off of this quarter point? Perfect. Where'd it go? Right back to the top one. Rejected this one, came back down to the top one. Missed this one by like 40 pips, and it went back to the next one. Rejected off of this one, came back down to this one, right? So usually you want to play them as targets, right? You want to use them as range finders. So if you see that a quarter point is rejected, you usually want to see, okay, where is price reversing? Is price showing me a different entry? For example, right here, um, right? It went above, it went through it. So now you kind of manage your trades by saying, okay, it gave me this breakthrough of it. However, I want to see a closure above it, right, or below it. What ended up happening? Your week ended up closing below. Your week opened a little bit higher, but then it continued to drop off, right? And because of this, you could have said, okay, well, position is still showing me bearish, so there's no reason to buy. Perfect. So now what would be your target? Your target one would be here, your target two would be down here. And eventually your take profit would have gotten hit over the span of a couple of weeks. But either way, you're playing it in a very, very, very well educated manner because you are using your quarter points as targets. And you're using your quarter points as added confluences, as kind of like areas of interest where price can return to and where price can in the future go, right? A lot of times you will find people calling these whole numbers, which are completely fine, but I call them by what I was taught, which is quarter points, right? So I hope you guys can backtest this and find it for yourself as a bit of a range finder. Go back and backtest some of your profitable trades, and you will end up seeing that these quarter points also had something to do with them. Maybe it bounced off exactly where your limit missed, or maybe it told you exactly where the Wyckoff schematic was going to test to, like right here, right? It tested right here, boom, and where'd it go? Straight back to the other one. Continued going, jumped the creek, and it completely started going off until the next ones. It broke this one and it targeted this one, came back, retested very, very close to this position, and it just completely kept going up. So when you mix these with confluential market structure, you're going to find places where the market will return to, right? And this is one of the most important pieces of our trading, because we want to be reactive, not predictive in the market, but at the same time we don't want to be left out just staring at our phones all the time, just quote unquote to be reactive, right? You want to know where to even start looking at price. And usually when these quarter points get hit, usually that's a good example or a good cue to say, hey, this is this price is going to react one way or the other very, very decisively very soon. So this is how I want you guys to trade them. Mix them into your confluences, okay? Say you have a schematic. Check if there's any quarter points around. Maybe it's above the spring, right? Maybe it's maybe your UTAD or your spring actually hit a quarter point, and that's why it was the UTAD, or that's why it was the spring, right? Those whole numbers are usually going to get targeted by banks because that's how they think, right? Banks move better in whole numbers. They're prettier. They're easier on their spreadsheets. They're easier on their finances. So what are they going to do? They're lazy. Why? Because they have the power of the whole market in their hands, right? So obviously they're going to target these whole numbers, right? So I want you guys to backtest this. I want you guys to add this into your confluences. They're very, very simple and straightforward. They're ranges. They're range finders, meaning that if one is bounced off of or rejected, it will usually target the next, right? So whenever you take a trade, maybe try targeting a quarter point. Maybe that'll work for you. Maybe it just breaks straight through. Okay, great. Watch for your retraces, watch structure for your retraces, but most likely you're going to be targeting the next quarter point after that in the future. Okay, so I want you guys to backtest this, and I want you guys to tell me how it goes. Make a case study on it using quarter points, right? And actually start realizing that these points are very, very important for you guys. All right. Well, cheers, and I'll see you guys in boot camp today.